Okay, today my favorite part. Coming back to my favorite part. Where is my polls? I'm missing my polls. Yes, I found them. Starting my first poll. Can you see, guys? Home bias. Can we use avatar? No, Ankur. You don't go. Don't get too what we call optimistic of that. We will try and do something. Okay. If you had 1 lakh rupees to invest today, how much would you invest outside India? Mera Bharat Mahan, India is enough, is a first choice, up to 20%, 20 to 40%, okay, or more than 40%. Ma'am, please vote. Monali, vote. Don't poll. You just vote. 20 to more than 40% is 50%, na, ma'am. Sir, can't see poll. Monali, madam, आपको poll नहीं दिख रहा है. Everybody is voting. In fact, 80% people have voted. I think you have logged in from the mobile or something like that. That's why. Okay. I'm ending the poll, sharing the results. Okay, the results say up to 20% is 60% of the people are saying that up to 20% they will go for foreign investments. 18% are saying that 20 to 40% we can go. 16% are saying that no, India is the best, and 7% are saying more than 40% we can go. Okay, going to my next poll, poll number two. What is the biggest wealth creator? Okay. Over the next 10 years, which market do you believe will create the highest wealth? India, USA, Asia, globally? I know दिल के अंदर मेरा भारत महान वाला रहेगा, तो you will tend to click the first one, but think very smartly and tell me. Okay, over the next 10 years, which market do you believe will create the highest wealth? India, USA, Asia, or a globally diversified portfolio? Come on, guys, 67% have voted. Come on, come on. Let's see. It gives us motivation to put up more polls. Okay, now 75% of people have voted. I'm just sharing the result. Okay, 50% say India, very bullish. 6% say USA, okay. 6% say Asia, and 38% believe that it is a globally diversified portfolio which will be the biggest wealth creator. Okay, poll number three. What stops you? What is the biggest reason Indian investors hesitate to invest globally? First is currency risk. Second is fear of unknown markets. Okay, a lack of knowledge. India will outperform everything. What do you think is the biggest challenge which stops many of the Indians? Okay, to invest outside of India. आई थिंक इसमें तो मैंने एक डालना ही भूल गया कि हाउ डोंट नो हाउ टू लैक ऑफ नॉलेज हाउ टू इन्वेस्ट. आई थिंक दैट इज वन ऑफ द बिगेस्ट चैलेंज विच मोस्ट ऑफ द पीपल फेस, बट आई फॉरगॉट. Come on, guys, you can vote yourself. Okay, I'm ending the poll, sharing the results. Okay, 49% say lack of knowledge, 38% say fear of unknown markets, 7% say currency risk, and 6% think that it is India will outperform everything. To my last two polls, okay, come on, let's be fast. Uh, which statement do you agree with the most? Invest only where you live, invest where the best businesses are, follow the best performing market, or balance India with global opportunities. Come on, come on. हाँ, अगर ये रियल एस्टेट होता तो मैं 100% बोलता था इन्वेस्ट वेयर यू लिव. It's very difficult to keep a track of other houses in other states. I have learned it from one of my friends of Marcellus called KB. He stayed in Bombay. He used to buy one house in Bangalore, one in Jaipur. It's very hard to maintain. Okay, sharing the result. 66% say balance India with global opportunities. 22% says invest where the best businesses are. 9% say I'm omitting the fifth poll, but I am launching you one last question, okay, before we start the presentation. Hope you can see this. No, it's not coming. Yes. Which of this is a multiple selection answer? You don't have to select one, you can select many. Okay. Which of these companies do you use almost every day? You don't have to click one, you can click many. You can use Apple, Google, Netflix, Amazon, Facebook. You can click all the multiple things. एप्पल एप्पल का आईफोन मेरे सामने आईफोन है, मैकबुक है, गूगल तो अंदर ही है, नेटफ्लिक्स तो उसके बिना मेरे को रात को नींद नहीं आती है, अमेजोन फॉर एवरी शॉपिंग, फेसबुक, इंस्टाग्राम, व्हाट्सएप वो तो, और एक मेरा लिंक्डइन मैंने नहीं डाला, ओके, उबर ऑफ कोर्स। बाप रे, मेरे को ऑलरेडी ऑलमोस्ट आई यूज एवरीथिंग ऑन डेली बेसिस। Okay, guys, 80% have participated. I'm ending the poll. The beauty is 96% people use Facebook, Instagram, WhatsApp, 88% use Google, 57% use Amazon, 36% use Netflix, 29% use Apple, and 22% Uber. I think I have set the stage for Pramod sir. Pramod sir, welcome to the show. Just a second, he connects.
Thank you. Thank you.
Okay,
This was super fun.
friends, we have with us Mr. Pramod Gubbi. He is a CFA by education. He is the co-founder of Marcellus plus the sales head of Marcellus with Marcellus for quite long time. And sir, थोड़ा अपने बारे में भी बताइए ना, please. So before we start this, because I think your work experience and everything will speak a lot about what we are going to talk today.
Yeah, no, I mean, yeah, I can talk about all the mistakes that I've made because that is what makes it relevant. That's what experience is meant for, not for any glorious statement about oneself. Um, but yeah, I mean, first I must say I enjoyed your poll very much. It's a great way to set the stage and get everybody excited about what's on the agenda. But yeah, I mean, just to let the audience know a little bit about myself. I was born in Bombay, but grew up in Bangalore mostly. Then I did my engineering from those days. It used to be called KREC Suratkal. Now it's called NIT Karnataka. Um, I did it in electronics engineering. And I started working with Philips Semiconductors as a semiconductor design engineer. I did the biggest mistake of transitioning to the markets. Imagine if I had remained a semiconductor engineer today, I would have participated in your poll, perhaps created some of those. In fact, I was working with a company which is now literally, many of you might not know, TSMC was seeded by Philips. ASML was spun off from Philips. So I was with a company which has created the two greatest semiconductor companies. But yeah, and what could have been is different. But around the dot-com bust, I got curious about understanding the business of semiconductors, not just the engineering side. So I went and got myself a business degree from IIM Ahmedabad. Post that, I wanted to get back into tech because I wanted to use my engineering degree, but more in a business function. So I joined HCL Technology Semiconductor Division in business development. A few years later, I bumped into my current colleague and partner for 21 years, Saurabh Mukherjee. He was looking for somebody to do research on semiconductor stocks in the UK. So it was a contiguous career move there. It was not like jumping into equities or finance or stock markets randomly. My experience training in semiconductors meant that he said, that will be far more valuable for investors.
So we can
Using
call this actual fundamental research.
Correct, absolutely. Because that time our approach was look, valuation, DCF, accounting, financial analysis, तो कोई भी कर लेगा. Unless and until you understand underlying industry में क्या होता है, what will be the value add you will give to investors. So almost every analyst we hired was somebody from industry background. For example, Rakshit, my other co-founder in Marcellus, He became an insurance analyst at Clear Capital. Before that, he was working at ICICI Lombard Insurance
Okay.
as a risk assessor. So so our biotech analyst also came from biotech background and so on and so forth. So I did research for a few years. By 2008, I don't know, many of you know, Saurabh was one of the first to call the subprime crisis in the UK. In 2007 February, you put out a research report saying that the subprime crisis will happen, and then we know rest is history. So we got a lot of credit for that work done by Saurabh. So we became very popular in the UK. At the same time, that crisis actually destroyed the British economy and the British stock markets. So we were very young and we said that, look, we don't want to bet our futures on the UK. Luckily, our clients who were happy with our work said that, look, what you've done in the UK has been very useful. If you can replicate this in India, it will be even more valuable because unlike the UK, India has a brighter future. This was 2008. And unlike the UK, India is alien to us. We don't understand India well, but we have investments in India. We would need people who we trust to help us with our investments in India. That's how Saurabh and I started working on the Indian markets, 2008. Initial days were very interesting, very exciting because we did a lot of work on forensic accounting. Then nobody had heard of the work forensic accounting only. And this was the go-go days of power, infrastructure, many companies from your city, Hyderabad. So we wrote explicitly about them. Many of them have literally gone to zero in terms of stock. But that made us very popular in India very quickly. Literally, we wrote our first report 3 months before Satyam happened. So had that not happened, perhaps we would have been grinding our way to get everybody's attention. So it was a huge stroke of luck. We talked about accounting quality, and India's biggest corporate accounting scandal blew up. Right. So that day, I remember because on the research report, it was my number because I had moved from research to sales. So, as the sales contact, my phone did not stop ringing. I got calls from investors from New York, London, Tokyo, Hong Kong, Singapore saying that, look, I don't know what you guys have done. Nobody talks about accounting quality. You guys come from nowhere, talk about accounting quality, and Satyam blows up. And remember, Satyam was a Nifty stock, NASDAQ listed from an industry like IT services, which had made a name for corporate governance. Companies like TCS, Infosys were known for that. So nobody expected this to blow up, and the stock was down 80% one day. So these investors called me and said, Pramod, I have 20 stocks in India. Can you help me if there is another Satyam in there? Can you do some research on my portfolio? So because of that, we became very famous and we ended up doing a lot of bespoke research. And with that, we could map out, which are the clean promoters in India, which are the Gunda promoters in India you need to stay away from very quickly. So that helped us build our franchise. So gradually, in 2010, our company was owned by a Portuguese bank. And again, Saurabh's financial research helped. He said, look, Portugal is the P of the pigs. I don't give this bank a few months to continue. So let's find a new home. So we moved the whole business and team out of this Portuguese bank to Ambit Capital. So we built Ambit Capital's institutional equities business from scratch. By 2013, a lot of foreign institutional investors from London and New York had moved to Singapore and Hong Kong. So Saurabh asked me to move to Singapore and build that business. 2013, I remember, was pretty much a time like this. If you remember, it used to be called the taper tantrum, where the US Federal Reserve was tightening monetary policy and the balance sheet, and the rupee was falling like exactly like this. And then when I moved to Singapore, I remember one of my hedge fund clients who really liked my work, and I moved to Singapore on the basis that clients like that will give me business. First day after moving, he said, "Look, I don't think my fund will only exist. Why have you come here?" So, but it was really scary. I had just uprooted my family, taken my kids out of school, put them in a new school in Singapore and all. And these guys, one of my best clients is saying that he may not exist. What will happen to the market? What will happen to your job? But big lesson because that was perhaps the best time to invest in your career, invest in the market. As we know, 2013 September, Raghuram Rajan became the RBI governor. The same FCNR scheme was launched. India got bailed out. Not just that, the whole Modi election rally began from November 2013, and the rest is history. So my 3 years in Singapore was fantastic. We did a roaring business. I learned a lot. I improved my understanding of the market. By 2016, we had become top three in India. And 2016 also marked the year where we published the book Unusual Billionaires. Unusual Billionaires was basically a compendium of deep research reports on long-term wealth compounders in India like Asian Paints, Berger, Marico, HDFC Bank, and so on. So the book though became a hit, but we got a lot of requests from investors saying that you do all these deep research. Why just advise other fund managers? Why can't you launch a PMS based on this strategy? So that's when we launched Coffee Can PMS. Saurabh said, let me run this. You come back from Singapore and run the equities business while I see how to build an AMC. 2017, 18, the fund did well. 2018, in the crash, did PMS became the best performing PMS in the country. As our style, you would by now understand, we'll always do in bad times. In bull markets, we never outperform. In fact, we will underperform. But the whole premise of this philosophy was built on first, let's protect investors' wealth. Then we'll think of compounding, right? Because while we all know high risk, high return, and all, I think in reality we see investor behavior, right? When things are down, nobody stays to see the recovery. Everybody would have exited. So, practical way of giving long-term compounding is avoid the downside or minimize the downside. You can't really avoid. So because 2018 it became a best performing PMS, we got a lot of clients say that we want to invest with you, but only if you are independent. So that's how Saurabh, Rakshit, and I said that look, we built businesses for other people all our life. We are not getting any younger. Let's do something for ourselves. So that's how Marcellus was born. 8 years, it's been a roller coaster. As many of you might know, first 4 years was fantastic. Our performance was brilliant. Asset growth was also superb. And as is inevitable in life, in markets as well, up cycles are followed by down cycles. Our performance went down, AUMs declined. But in that, we did a couple of good things. We continue to invest in the business. First, the topic of today's discussion, we invested in a global fund 4 years ago, saying that ultimately Indians need to make money to look after their families. How does it matter where they make money from, whether it's from India or US or whatever? We need global diversification. I'll come to more details of that. Second, we invested in factor investing. Factor investing is a popular term today, but this was 4 years ago when we found a very successful manager from Morningstar who built our factor PMS, which is done really well. And as you know, today almost every AMC is launching factor funds left, right, and center. And third thing we did was to invest in multi-asset PMS because we realized again the benefits of diversification. No point in putting all your eggs in one basket. You need to diversify based on asset allocation, and even multi-asset is taken off today. So I call it luck or in foresight. 4 years ago, the three places we invested in, global, factor, and multi-asset, all three are in demand today. And coincidentally, our domestic PMS is also making a rebound in terms of performance. So yeah, at Marcellus, broadly, I don two hats. One is I lead the client advisory and relationships functions. We don't have a sales function in Marcellus. We believe in a fiduciary role like asset management, where we look after people's hard-earned money. You should not sell anything. You should just advise, and nobody takes advice from random people, no. So you should build relationships. So client advisory and relationship is the function that I manage. Alongside that, I sit on the investment committee to make sure our fund managers are adhering to the house rule. Otherwise, I don't have much to contribute there. But yeah, as a founder, that's my responsibility as well. So that's a long introduction to your quick question. I don't know if that sort of diluted the agenda, but I thought everything should have a context. I couldn't hear you. I don't know if your mic is.
Can you hear me now?
Yes, I can hear you now.
Great, sir. So, in fact, almost 50 to 60% things of Marcellus I also didn't know. Okay, which you shared it with us today. It was
Right,
fantastic,
right.
sir. So, over to our first thing, what we were talking about, global opportunity. Okay, sir. A lot
Sure.
of partners who are there in the call have participated in the NFO. Okay,
Right.
so many of the people now understand the fund, what we are doing. We are only into emerging markets and everything. So you can just go through a small presentation of what is the fund, then we can go to the what, how is the new fund now, what is the portfolio. We can discuss those things also, because
Sure, sure.
around 46%, 46 partners have already participated in the Marcellus.
Okay. Got it.
Out
Got
of the
it.
120, 130 today, already 46 have participated in the group.
Oh, wow. Okay.
And
Fantastic.
one more thing, sir, matlab, a lot of people, partners, when I was asking them, still talking about this fund, were asking me one common question, sir, why are FIA selling?
Ah,
And you are promoting the same fund at the same time. If I also
right,
moving
right, right.
out and you also want to take our money out, is there any correlation between both of you, or how is it?
Ah, okay, okay. No, I understood your question. Look, I'll answer that question only first. Why are FIs selling? I think the first and strongest answer is interest rates in the Western world, right? If you look post global financial crisis, 2008 till now, interest rates have been close to zero till about 2022. It's only after Putin invaded Ukraine, inflation started going up. On the back of that, interest rates also gone up. Now, interest rate on US government bond yield is about 4.5%, 4.6%. It's gone up in the last few days again. Now, 4.6% dollar return versus for a long time over the last 18 years was close to 0 or 1%. Right? Now, if you are a pension fund manager in the US, right, if you are getting 4.6% dollar return, for you to invest in emerging markets like India or China, for that matter, even Korea and Taiwan, by taking country risk, currency risk, regulation risk, it's a bit too much, right? So that's the foremost reason why FIs are selling. And by the way, a lot of people think that FIs are selling India because India does not have an AI story. They're selling India and going to buy Korea and Taiwan. That is also not true. If you see the FI numbers for Korea and Taiwan, they're selling Korea and Taiwan also. Korea rally is happening because of retail investors in Korea, much like how
India.
mutual fund flows into Indian mutual funds are keeping markets steady at least. In Korea, people have sold their house, jewelry, everything, and bought Samsung and SK Hynix. That is a crazy rally. So that's the number one reason. So I don't think that reason will go away. Inflation is here to stay. US government debt is high. So therefore, US interest rates will remain high, if not become higher, in which case I don't think FIs will come back in a hurry, at least this the way they used to invest between 2008 and 2022. So but that is not particularly relevant for our investment decision making process. It is nice to discuss all those things and try and understand what is happening in the world. At the end of the day, there's only one way to make money. I'm talking as a value investor, where you buy good companies which generate good profits. Make sure you don't overpay in terms of valuations and stay invested for long periods of time. The company can be in India, in US, Korea, Taiwan over long periods of time. This method will ensure that you will make a reasonable amount of money. Now, not all companies you thought were good will remain good. Some of them will get disrupted. Not all companies you thought will grow at a certain rate will grow at that rate. Even if you get 6 out of 10 companies right, you will create immense amount of wealth. Remember, it's not the hit ratio or the rate of return. It is the time which gives the power to the compounding. And compound interest formula, which our teachers taught us in, I don't know, fifth standard, I think, is basically A is equal to P into 1 plus R to the power N. You can see which is the most powerful one, not the principal P, not the rate of interest R. It is what is exponential, which is N. N is the number of years.
But
So
everybody forgets it.
everybody forgets it. Everybody forgets it. We want to become rich tomorrow only. So we all look for multi-baggers and stuff. Now, multi-baggers over a long period of time will be many, but we want multi-baggers tomorrow. But that is not any of our fault. All of us are driven this way by evolution. Human evolution has created us species to be excitable. Like they say, fright or fear. So we are naturally tending towards euphoria or despair. We'll
Okay.
say, wow, fantastic. Next bull market is around the corner. Next 3 years will be fantastic. Or we'll say, no, India's underperformed. We lose all our money, get out of the market and redeem. That is the natural human tendency. Very few of us can conquer. We can conquer. It is not impossible through training or, of course, keeping the mind calm in today's world is difficult with all the distractions around social media, your mobile phones, and everything. But maybe a little bit of meditation and yoga can help. But yeah, I mean, that's at best we can do. We
So
can just
meditation will actually help us in making money also.
absolutely, absolutely. So the devil is not the government or Trump or Iran. The devil is inside us. So we need to tame that devil. But yeah, enough of philosophy. I'll jump into the global fund. So I'll use. So in fact, that euphoria and despair could be a good starting point, right? I always say that investment is not about what are you investing, how are you investing. Most important question is why are you investing? Always start with the why. There's a beautiful book called in that name called Start with the Why by Simon Sinek. Before you do anything, whether it's investing or work or travel, you should ask, why am I doing what I'm doing? So we'll address that piece first. That's the biggest challenge because any investment strategy will inevitably go through its weak periods. At that time, if you've forgotten why you invested in the first place, that'll be the biggest challenge. So, to ensure that everybody invests with the right objective, I'll start with why. The wrong whys, let's start with the wrong whys. Wrong whys are the greed and fear I talked about. So, what we can do is, I liked Kapil's approach of doing polls. I will also do a poll. Maybe you can just type in the chat box or the Q&A box. Um, what do you think India's Indian market return has been in the last 5 years? Right? We all say last 2 years India hasn't gone anywhere, but before that 3 years it was good. Right? So 5 year return, except only caveat, give me the answer in dollar terms. For those of you with have mobile phones or laptops, you can even Google for iShares India ETF. Google or Yahoo Finance or whatever. iShares is owned by BlackRock. This is the largest India ETF, which tracks MSCI India ETF. Tell me what you see in terms of 5 year return there. Or if you know offhand, please type it in the chat box. I
Sachin
see
is
one
saying
answer,
8%.
8%. Any more answers? Dollar
Um,
returns of Indian market in the last 5 years. Like I tried to mislead you as well. Look, only 2 years have been bad. Before that, 3 years was good. So therefore, what could be the returns?
Dania is saying 6%. Vijay is saying
Eight,
close to
six,
4%.
four. Yeah, it's getting close.
Ujjwal is saying 6. Ronald is saying 5.
Right.
भाई इतना कम है क्या एफडी ज्यादा अच्छा है
Negative
मतलब
nahi hai. Negative nahi hai, sir. It's actually, I'll give out the answer. The answer is zero. It is flat. It's at the same level as it was. Right?
5 year returns.
5 year dollar return for India market is 0%. Right? Now, we're all investing for the long term. Somebody's saying lot of echo. Can you hear me clearly, Kapil?
I can hear you clearly, sir.
Okay, okay.
Anybody problem? No, sir. All
Um,
the audience have clear.
right. So we all want to look at long-term returns, not short-term returns. But 5 years is long enough, right? We'll all agree. 5 years is not short-term. So 0% in 5 years is quite scary, no? So
Very.
if I want anybody to buy my Marcellus Global Equities Fund, I will scare you guys by saying India has given 0% returns, right? But that is not the reason to invest. Just 2 years ago, just go back 2 years in time when we started Marcellus Fund 4 years ago, even for 2 years ago, we used to make a presentation. There used to be a table, first slide table used to be top performing markets in the world over 10 years, 20 years, 30 years. India was consistently number two all across time frames. Guess which was number one?
US or
US. US was the only market which had given double digit dollar returns over 10 years, 20, 30 years. India was the only other market which came close to it. Even Taiwan did not come close, despite Taiwan being a single stock market. One company is 50% of the index there. It is not even a market. No other market comes close, right? So if you look at point in time, today, you can say 5 year returns of India was bad. In fact, 10 years, India has underperformed emerging markets, despite in the last 20 years, India being the best performing emerging market in the world. So people tend to forget. It's easier to look at statistics and draw the wrong conclusions. So do not invest in our global equities fund because India has done badly. Most likely, India can do better in the next 5 years. That is how mean reversion works, right? This is the fear psychosis. Now, I'll give you the greedy psychosis as well. India's first global feeder ETF, I think Motilal Oswal's Nasdaq ETF was launched in 2011, right? It's been 15 years. Again, it's a poll. Can you guess what is the 15-year CAGR? Now, remember, this is a domestic mutual fund feeding into Nasdaq. So, therefore, the returns will be rupee denominated.
everybody is ready with 17%, 20%. I think everybody, a lot of people are following this.
Right. Yeah, go ahead. Few more entries. We'll see 2, 3 more entries. Anybody? 22%, 18. I think Ramesh got it right. Close. It's 23% actually. 23% compounding for 15 years, right? 15 years is a really long time. I told you the compounding formula 1 plus r to the power n. Any of you can put 1.23 to the power 15 and see what comes there. Crazy compounding, right? And just to give you a sense, India in this period, Nifty, for example, has compounded something like 11%, less than half the compounding of NASDAQ, right? In 15 years, I'm giving you long-term data. So therefore, it is easy to sell my global fund based on this data, right?
Sir, is
Well,
it because of the only the dollar rate
dollar
that's got?
actually added to it, but even otherwise, in dollar terms, NASDAQ has been good. But here is the catch. 2011, if you looked back the previous 10 years, NASDAQ returns was zero.
Oh my
Nobody will
God.
tell you that. Right? Point in time, it is easy to play around with statistics and get you to act whichever you want. So neither should you invest in our fund because India is bad, nor should you invest in our fund because US is fantastic. Both from a long-term perspective, 10, 20, 30 years, have given good returns, but both will go through phases where they will not give you returns. But how do you then decide? Now, the good news is, despite India and US being the top two performing markets in the world over the long run, they don't behave hand in hand,
Okay.
right? Look at the last 2 years. India has done very badly, US has done really well. Go back 3 years in time, 4 years in time, 2022, US was down 25%, NASDAQ was down 35%. India was the best performing market in the world, right? India held up. Leave aside global events like Lehman crisis in 2008 or COVID crisis in 2020. India and US behave very differently. What does that mean? In our technical jargon, it means low correlation, which means they make great constituents for a diversified portfolio. In fact, we have done the maths to show that if you had a 50-50 US and India portfolio, say 20 years ago, and all you did was rebalance it back to 50-50 on an annual basis, your 50-50 portfolio's returns would have been better than both India and US at lower risk than India and US. This concept of diversification of a portfolio across asset classes which have low correlation with each other was termed as the only free lunch in investing by a gentleman called Harry Markowitz, who won the Nobel Prize for this work in 1991. Right? Diversification is not just buying more and more funds or more and more asset classes. If all the funds behave the same way, that is not diversification. If all the asset classes behave the same way, that is not diversification. So you need to diversify basis low correlated assets. For example, I think something that will be fresh in everybody's memory will be gold and equities. Gold and equities are supposed to be having low correlation. And you saw the experience in the last 2 years only, right? All of your partners, you have clients. Imagine client A having 100% in Indian equities, client B having 70% in Indian equities and 30% in gold. How were your discussions with each of these clients over the last 3 years? Naturally, the 100% equities guys will be sweating a little more. He'll say that, look, am I doing the right thing? I'm falling short of my goal. What am I supposed to do? Should I redeem? Whereas a person with even 30% in gold would say, you know what, 70% is not doing well, but the 30% has helped me sleep peacefully at night because overall portfolio returns are okay. That ability to sleep peacefully at night is what diversification gives you. Just like gold worked as a shock absorber for your clients in their portfolio, global is meant to achieve the same thing. Therefore, anybody who says invest in global because next 3 years global will give you good returns is wrong. Nobody knows the future, right? I don't know the future. Nobody can predict the future. It's by definition. If we all knew the future, we'll only buy that one stock which will give the highest returns. Why talk about buying a market or a fund? Nobody knows the future. Diversification is insurance against that unknown future. Why do we all buy life insurance policy? If somebody told me that, Pramod, I've done all the tests for you, 100%, there's no chance of you dying before the age of 75. Because most life insurance companies give you sum assured only till 75. If somebody told me I will stop paying life insurance premium today, what's the point? Insurance is to protect yourself against uncertainty or risk. Same thing. Global diversification is an insurance. Anyway, most of your clients' portfolio 100% is in India, right? If let's say you invest in this global fund, you allocate 5% to this fund, and global does really badly in the next 3 years. But what did I say? Global and India are uncorrelated. In the situation that global does badly, there's a good chance that India does well. So therefore, your 5% might have done badly, but 95% would have done well, no? But what about the scenario in which global continues to outperform India and you are left with 100% in India? How are you catering to your clients with that small scenario, even if it's a small probability? So, which is why the number one reason for investing in globally is insurance, which the term I use is diversification. Luckily, we are blessed with the fact that the best performing market in the world, which is the US, has very low correlation with India. If you can combine the two, you're able to achieve the impossibility of high returns, low risk.
Sir, a lot of partners are asking whether you are changing the slides or it's
No, I
standard.
haven't changed the
Oh,
slides.
okay.
The slides tend to be a distraction. Now we'll move to
Okay.
distraction.
Okay.
So diversification is the first need. Happy to take questions on that in the Q&A section. The second is a bit more practical, which is where the poll comes in, what Kapil showed, right? Some of you might ask me, Pramod, you said 5-year dollar returns for India is zero. Why should I worry about dollar returns? I live in India. I earn in rupees. I spend in rupees. No, for me, rupee return should matter. But unfortunate truth is that we are living in a globalized world where our own consumption basket and I'm glad I could see the results of that poll. All of you are using
And I
global
can share
products.
it
No,
again.
products and services from global companies. You might be using, first of all, how are you attending this call? This is a Zoom call.
Call.
Zoom is an American company. Most likely, you are taking this call on your laptop, which is an HP or a Dell. Which operating system is it running? Windows, which is Microsoft, American company, or maybe you're taking it on your mobile, which is a Samsung or an Apple. And like Kapil said, you're going to Google the statistics I just stated, just in case I'm giving you the wrong statistics. And after hearing my boring presentation, you would want some entertainment. You will switch to Netflix, and then maybe you will order a headache pill on Amazon. And WhatsApp, Kapil, how bad the presentation was. Maybe we'll take Uber and go somewhere else to relax.
So not
Right.
even a single partner has left your presentation in the last 1 hour, 45 minutes.
Right. So this is the reality. Worst case, you don't use any of these products. You will go from one place to another
Uber.
on made in India two-wheeler, but you will put what? Petrol in it, no? Petrol comes from crude oil, and as you know, today newspapers will not let us forget where the crude oil comes from. It comes from the Middle East. Crude oil prices are $75. It's not 75 rupees or $92 today, right? It's dollar denominated. So dollar and global is part of our lives. It's part of our expenses. So why should we not have dollar and global in our assets, in our investments? Right? It's not just today's expenses, our aspirations. A lot of your clients would want to send their kids abroad to US universities, UK universities, some of the best colleges in the world. This will require matching your liabilities, future liabilities, with assets in the same currency. Your holidaying, high tech graduates. So, our dreams are also in dollars. So, we should make sure we have enough investments in dollars. So this is your overall portfolio. Most of the things you're doing right. You've got domestic mutual funds, you've got direct stocks, you've got gold ETFs, maybe REITs for real estate, fixed deposits, bonds. But if you don't have global, you're missing a big, big piece of the puzzle, right? That's the reason why you should invest in global. That's the why. Um, what is the solution? Now, unfortunately, the mutual funds which were investing in global funds have stopped taking subscription. No, that would have been the easiest way. For whatever reason, you and I can debate later on. The RBI has put a $7 billion limit on mutual funds investing globally. Unfortunately, that limit has been breached. So, whatever few funds which were open for subscription, they've also shut. So, what is the solution? Now, your clients can go and buy an S&P 500 ETF or a NASDAQ ETF on interactive brokers. But remember, we are talking to an audience which does not want to do direct equities, which does not want to open a brokerage account. They trust in an advisor like you and a fund manager like us. They want us to manage them. For those, Gift City is opened up as the best avenue, right? We started 4 years ago, largely starting with a fund which catered to high net worth individuals, because at that time we were in that type of business. Now, more and more Indians are saying, why should we small investors be left out of it? For that, last month we launched the Global Retail Fund. As you can see, many of you who have participated in the NFO, thank you very much. Appreciate the support, and hopefully we will not disappoint you in terms of returns. For those of you who are new, these are the details in a summary. It's a retail scheme, minimum investment of $5,000. It's largely for Indian residents. Whenever I say global, a lot of people ask me, "Oh, is this for NRIs?" I say, "Arey, NRIs have a lot of options anyway. Whether they live in Dubai, Singapore, US, they have access to their mutual fund limit is not breached. It is Indian mutual fund limit which has been breached. So therefore, this is a solution for Indian residents. Primarily, Indian corporates can also invest. Very important thing to note is the difference in taxation that you are familiar with between domestic mutual funds and a global fund, right? There are two main differences. One is um, the tax rate and the tax period. For example, we are familiar with long term capital gains tax and short term capital gains tax. In an Indian mutual fund, Long-term capital gains tax is any gain after 12 months. Short-term is anything less than 12 months. Long-term rate is 12.5% plus GST. Short-term rate is 20% plus GST. And when are you taxed as an investor? Only when you redeem from the fund, right? Now, in global, all these things are different. One, definition of long term is not 12 months, but it's 24 months, right? Second, long term rate is the same as domestic at 12.5% plus GST, but short term, very important to know, it is almost double. It's 40%, right? So short term taxes are quite punitive in global investing. We are a very low churn fund manager, but still it is very punitive. To avoid that, we put a 2% exit load, right? So that we know by now, all of you would encourage your clients to invest in equities only for the long term. But still, for whatever reason, somebody needs the money is available to them. But you should tell them that the fund will deduct 2% before giving. It is more like a way to discourage them from short term behavior. And here's the big difference. In domestic mutual funds, the investor pays the tax upon redemption. The fund does not pay any tax. But in global funds, the investor does not pay any tax on their own. No tax payment, no tax compliance, no tax administration at the investor level. All the tax is paid by the fund itself. Right? What the investor gets is post-tax NAV, post-tax returns. Right? Very important to remember, very important to explain to the investor as well, so that they come with their eyes open. Now, I would have loved the short-term capital gains tax rate to be lower, but I'm not the finance minister. So we'll have to live with that. But we'll do our bit from our end to have very low turnover in the fund. From your end, if you can encourage the investors to ensure that they stay invested for the long term, we will be able to minimize the effect of high short-term capital gains tax. The expense ratio is 1.75% fees plus 0.25% is the operating expense of a fund in GIFT City. It's an open-ended fund, so it's daily NAV, so you can top up anytime you want. The first check has to be $5,000. After that, you can top up with a minimum of $2,000. Remember, both 5,000 and 2,000 are minimum. If you want to invest larger sums, you're more than welcome. We'd love to manage that as well.
Which a lot of people want to invest, but because of the TDS factor, they're stopping themselves at 5 and 10.
Now, TCS, I'll tell you, I have been investing in our global fund for 4 years. It's not a factor at all. For those of you who are not familiar with the TCS concept, TCS stands for tax collected at source. You might be familiar with the TDS concept, tax deducted at source, where, say, if you're a salaried person, your employer, before paying your salary, will deduct the tax and submit it to the income tax department on your behalf. End of the year, like right now, most of us will be doing our ITR filing. We can see it. The employer has submitted. TCS is whenever we send money out of the country, or we have to send it through a bank. All banks have been instructed that whatever money we send, a percentage is deducted as TCS, on top of it collected and deposited with the income tax department in your name only. Right? This is tax collected. This is not taxed. That money is available to you. And you can recover it in 3 ways. Now, the TCS rules are such that for the first 10 lakhs, TCS is 0. About 10 lakhs, it is 20%. For every rupee you take, they will deduct 20%. So let's say you want to invest 15 lakhs worth of dollars into our fund. So you go to your bank and you instruct them to transfer 15 lakhs to our fund. For the first 10 lakhs, TCS is 0. 10 to 15, that 5 lakhs, they will deduct another 1 lakh. 20% of 5 lakhs is 1 lakh. They will deduct 1 lakh. The bank will deduct 1 lakh. So total debit from your account will be 16 lakhs. 15 lakhs will come to our account. In your name, we will issue units. 1 lakh will go to the income tax department in the investor's name under their PAN. Now, this 1 lakh you can recover through three means. One, last year onwards, the government has allowed TCS to be adjusted against TDS. So if your client is a salaried individual, the bank, the moment it deducts that extra 1 lakh from your account, will issue a TCS certificate. You just take that TCS certificate, your client takes the TCS certificate and gives it to their HR department in their employer. HR will stop deducting TDS from the salary from next month till such time this 1 lakh is paid back. So if your client is a high earning and where their TDS itself is 1 lakh, you will immediately get it within 1 month, right? This TCS is adjusted within 1 month. Let's assume you're not a salaried employee. All of us invest in markets. We might have sold some shares, sold some mutual funds. We have triggered capital gains tax, which we have to pay on our own as an advance tax. Better to pay advance tax, otherwise government will charge penalty. You can adjust this TCS of 1 lakh against that advance tax due. Let's say I've sold shares and incurred a capital gains tax of 1 lakh. I have to pay it to the income tax department. I will tell the income tax department, that 15 lakh I invested in Marcellus Global Fund, for which you collected 1 lakh TCS, use that against my capital gains. You don't have to pay anything. Worst case, you are not salaried, you don't have any advance tax payment. When you file the ITR returns, this 1 lakh is refunded to you. I think if KB is around, he might correct me. The government might pay some interest also on that 1 lakh to you. So this is not money gone. This is a cash flow mismatch, which can be addressed through these means, through adjusting against TDS, through adjusting against advance tax. So I will not hesitate from investing large sums because of TCS. I will focus on what is my asset allocation. If my asset allocation demands me to have, say, 25% global allocation, I would say don't jump to 25% overnight. Have a target that I will reach 25% in the next 2 years. Every month, I will do like a SIP of sorts. I will put $5,000 first and then keep topping up to 2,000 or whatever makes up the number to get that 25%. So TCS is not the reason you should not invest. That is your money. It remains with you. You can get it back. But primary work to be done is asset allocation, evaluating our fund on its own merits, whether this is the right fund. Now, remember, a lot of new funds will come up. As we are speaking, another big AMC is launching global funds. You can see which way the wind is blowing. So you'll have plenty of options, but evaluate us purely on our merit. So coming to that point, this is the team that manages the portfolio. Arindam Mandal, he's spent more than 2 decades in the US. He's based in New York. He runs the show here as far as everything global is concerned. He graduated from REC Warangal, worked with Oracle, moved to the US. He did his MBA from Fuqua School of Business and topped the class. He was hired by Principal Global Investors, one of the world's largest AMCs. He got his training in asset management or fund management there and gradually became the fund manager. We were lucky to get him to join us in 2022. He's been with us for 4 years. He's ably supported by our head of global research, Jaibir Sethi. Jaibir, in fact, was colleagues with Saurabh and me between 2005 and 2010 at Clear Capital. He was poached by one of the richest people in this country, Mr. Azim Premji. Many of you might be dialing in from Bangalore. Azim Premji is the founder of Wipro. He's one of the richest people in the country. He runs a family office called Premji Invest. In fact, Premji Invest was one of the first investors to seek special permission from the RBI to invest globally in 2016, 10 years ago. 10 years ago, it took $1 billion of his money and invested in the best technology companies in the world. You can imagine, already a rich person has become even richer now. So to do that, he took Jaibir's help. Jaibir was leading the technology research at Premji Invest. Again, we were lucky to have him back, join us back. So he leads our research on technology and also manages a team of 4 other analysts who cover consumer stocks, healthcare stocks, financial stocks. Arindam himself is an expert on industrial stocks. So between the team of 6 people, they have very good grip on international. All 6 have international fund experience. Right? They have nothing to do with our domestic PMS research team or fund management team. So that's the credentials of the team. We have an office in Gift City. The trader sits in Gift City. The principal officer is there. The compliance officer is there. And Prashant Mental is the fund manager and analyst as well. And the most important thing, returns. This is not the only thing on which you should invest, but the advantage we have is, like I said, we were one of the first to start in Gift City. 4-year return is close to about 20% in dollar terms and 25% in rupee terms. Um, Having said that, as you can see, just to ensure that I am not setting your expectations wrongly, remember this sort of a return, 20% dollar, 25% rupee return, we got lucky with the timing of the launch of the fund. When did I say we launched the PMS fund in October 2022? The 12 months before the launch, US markets had fallen 25%, NASDAQ had fallen 35%. And 1 month after the launch, ChatGPT happened. The whole market was on fire, so we benefited from it. Let's be humble and say this is not fully our credit. In fact, the market has also done well. However, from a cross cycle basis, let's say you're not as lucky as we were. Now, we continue to invest our own personal money, so timing doesn't matter. If you invest in the 5-year time frame, the idea is to get to about 15 to 16% rupee return post fees, post tax. The reason is we invest in companies which compound their profits at 15%. If you invest in companies which compound their profits at 15% and don't do valuation mistakes, your returns are more or less likely to be that. Remember, rupee depreciates by about 3%. Knock off fees and taxes, which takes away that 3%. So what you will get is about 15, 16%. Don't hold me against it. Nobody can guarantee equity returns, but that's to make sure that you don't get swayed by past performance. This has been an exceptional period of returns from global. But yeah, I mean, if we manage to replicate this, we'll consider ourselves lucky. You should consider yourselves as lucky. That's a bonus. Right now, there are some big themes happening globally. We're trying to benefit from it. You should not look at these themes as the only themes that we will play in our fund. These themes are dynamic in nature. For example, we made a lot of money from semiconductor stocks. Today, we have very low exposure to semiconductors because valuations have gone up. However, there are other ways to play AI. For example, power generation is a play on AI. Because what we've seen is all the data centers which are powering AI models are heavily energy guzzling. They consume a lot of energy. And what the US has found out is 40 years ago, when they started globalizing their manufacturing or outsourcing their manufacturing to China, they did not have any need to expand their power generation capacity. Suddenly, because of data centers and AI, they've realized they are going to lose the war to China. And remember, there's a Cold War between US and China. And it is clear now, whoever will win the AI war will be the next superpower in the world. And it is also clear now, whoever has more electricity will win the AI war. And China has a lead there, right? China has lots of renewable energy, battery technology, and all that. So US is catching up, which means that US is spending a lot on power generation. So we have bought, turbine companies, transformer companies in our portfolio to benefit from it. Similarly, defense and aerospace, as you can imagine, is a big theme. Even before Trump, there was geopolitics, because China clearly is at a stage where they think that they can be the next superpower. Rightfully so. They've achieved a lot in the last 20, 30 years. That means that the world that we were living in between, say, 1980 and 2020, where there was only one undisputed power, which was US, no longer exists today. When there is one undisputed power, nobody needs to spend on defense and all. It is a peaceful world. There are no wars and stuff. In fact, the only undisputed power was the only guy who was invading countries like Iraq and Afghanistan and whatnot. But today, with a tussle for the superpower status, the world has become a very unstable place. We are seeing that with the war in Russia and Ukraine, Venezuela, and Iran now. And therefore, every single country, on top of that, Trump has told the world, you are on your own. I'm not going to protect you. So every country has to spend more and more on defense. This is a great theme. And also, the nature of warfare is also changing. You no longer have tanks and Bofors guns. It's all missiles and drones these days. So you need to look at aerospace technology to benefit from that. And another theme is luxury consumption, because we are living in a world, it is the unfortunate truth that the rich are getting richer only. But it's a world full of wealth inequality. But we can make money from it, because the rich, their spending will not stop. They spend on their Ferraris and Lamborghinis and Louis Vuittons and Hermes. Whether there is a pandemic, whether there is a war, there is a recession, or markets are down, they will continue to spend on their luxury items. And many of the companies which sell those luxury goods are like 100-year-old companies. There's a heritage associated with luxury. So therefore, they are not disruptable brands also. Um, and hence you can make. Now you can see a lot of these themes simply don't exist in India, right? Whether it's AI, semiconductors, luxury, aerospace, and all that. So therefore, if you're investing only in India, you will be left out of these mega trends. And finally, a lot of the companies which benefit from these are world-class companies, right? So I would say, if you have to create wealth for your family, why restrict yourself to buying India's best companies when you can buy the world's best companies? Effectively make your portfolio world class. And by the way, it is not unpatriotic to invest outside India. In fact, I think it is actually unpatriotic to invest everything in India, by not letting yourself and your family benefit from global wealth creation. Because ultimately, who will become wealthy if Google goes up? Indians only will become wealthy, no? So if you are bringing global wealth to India, you're actually doing a service to your country. You're being more patriotic. So maybe I've addressed some of the questions that will come up in the Q&A. On that high note of patriotism, I'll stop my blabbering and take questions.
So the first question is from Hari. Any chance for the drawdown to reduce in the long term, in the near term or long term? Because $2,000 is a bit of 2 lakhs, so somebody wants to
Yeah,
make
we're
a plan
working
of
on
an
it.
SIP of 1
Yeah,
lakh
we'll
rupees at least.
Yeah, no, great question. So the point is, there are some fixed costs for fund transfers. These are fixed in nature, right? For smaller amounts, that will become higher percentage of the amount. So which is why we kept it, but we're trying to work around it. Now the Gift City is also expanding. There are a lot of payment service providers who are getting licenses, who are offering better and better solutions. So in all likelihood, this will come down. But for now, it is $2,000.
Okay, Sairam is asking any lock-in to withdraw it. Is it on a
There's
long?
no lock-in. Is being a retail fund, we are not allowed to put a lock-in, only exit load. So even in the first 2 years of your investment, you can withdraw, provided you pay the exit load. We will deduct the exit load.
One question from Prahlad. So the Motilal return of 23% was post-tax?
No, no, this is pre-tax, because you will have to. I mean, it's a mutual fund, right? So you pay the return, pay the taxes after redemption.
Okay.
I'm assuming if you're getting 23%, why will you redeem unless you have met your goals and all?
Okay. One more question was, does 12.5% tax at fund level consider the 1.25 lakh exception per annum in
No.
India?
So first of all, it's not just 12.5% at fund level. It is also the 40% short term.
No, if you go to long term only.
Long term is 12.5%. 1.25 lakh, anyway, I presume you already would have crossed that limit. Because remember, while this gift city is considered offshore when it comes to foreign exchange, because you have to invest in dollars, it is considered onshore when it comes to taxation. So your tax filing, everything will be the same as that you do for other Indian assets. So it's the same 1.5 lakhs that will cover this as well.
What is the minimum, any percentages for withdrawing of money? Matlab only this much money you can withdraw, or you can withdraw the entire
You
amount?
can withdraw any amount as long as post withdrawal your amount doesn't fall below $5,000.
Okay. Can you, sir, I think we forgot Ronald's question. You were supposed to show the portfolio, sir, current portfolio.
Yeah, yeah. Once again.
One question from Sachin. Value wise, US markets are higher as people saying it's a bubble. So, and India it's at fair value. Diversification is good timing, but is it the correct timing?
Again, first of all, I'm not a big fan of timing. I've been in the market for 25 years. I've made my fair share of mistakes trying to time. When you're younger, you think you know it all. You don't know. Secondly, when it comes to valuations, I can argue Indian markets are as expensive, if not more expensive, than the US markets. Having said that, in India, we are also fully invested. The idea is you don't invest in the market as a whole, no. We invest in stocks. Like in our Indian portfolios, we have anywhere between 20 to 30 stocks. In our global portfolio, we have 30 to 40 stocks. In a market of, say, BSE 500, surely you can find 30 to 40 stocks which are not that expensive, which are good quality. The same thing in a market of S&P 500, I can find 30 to 40 stocks which are not expensive. So it depends on where you're investing in. Like I said, because semiconductors have reached very high valuations, you will find that we've just got the semiconductor ETF. We're not playing any specific sectors. So if you see the biggest allocation, right, in the industry allocation piece, semiconductor ETF comes in the passive instruments. Aerospace and defense is the biggest allocation, almost 19%. Right, this sector is very cheap. Right now, the stocks haven't rallied at all. Similarly, industrials and machinery, very cheap. So we are focused on valuation. We're taking valuations into account and ensuring that we are not putting your money at risk. Yes, there are some pockets of the US which are expensive. We are avoiding that. Much like there are pockets in India also which are expensive, and you should avoid that.
Yes. So, Ronald's follow-up question was, what would be the diversification in terms of countries
So
investments?
yeah, geographic location.
Just below.
So Pramod, so it's almost 75% of our investment goes to the US market. The
Yeah, I was just showing
14%.
the fact sheet. So
All
as you
right.
can see, North America is 73.45%. North America includes US and Canada. Mostly US, maybe 5% in Canada, 68% in US. Europe is about 14%. Asia is 3%.
So, Asia is a does
Only Taiwan,
okay.
TSMC, is the only stock that we have in Asia.
Okay. I think the questions are covered. Need some inputs on the accounting or cost of transferring money from Indian account to your account. Need some inputs on the cost of transferring money from Indian
Yeah,
account to your
so there are two costs. One is the exchange rate itself, right? Let's say if you Google USD INR, you might see 96 today, but no bank will transfer your money at 96. They will keep their own spread, right? Now, depending on the bank, depending on your relationship status, you can get a good exchange rate or a bad one. So make sure that you check with your banker what rate they're giving. So if Google is showing 96, you might get the rate exchanged at 96.5.
Mr. Jagrut is asking, I have two questions. Given the USA has a huge debt and their economy is in fragile condition due to de-dollarization attempt by other countries like Russia or China via direct or indirect ways. Oh, I think Pramod got disconnected.
So I will answer all the questions. Seems like Pramod sir's net just went off. Uh, so
Achha, Ankur is asking, Kapish, how to check the latest fact sheet? Where will we get this fact sheet?
So every month on our website, all the fact sheets are updated, and you can visit our page marcellus.in. You can go to the offering section, select the Marcellus Global Fund, and you can every month the latest fact sheet would be auto updated. You can download the fact sheet every month from the website.
Okay. Uh, how is different from normal MF? Is there any difference between the normal mutual fund like Motilal ETF or this is okay? This is an MF roofed. This is MF roofed, Prahlad sir. Is it fund of fund or direct investment? It is direct investment. Any exemption available in long-term gains? Sure, I don't think so. There is any exemption available.
Yeah.
Okay, what will change happen performance of the fund if dollar is devalued to rupees 80 per dollar?
So let's say, so again, as Pramod sir previously mentioned, no one can time the market. Rupee coming down to 80 would be a plus point for Indian investors for their Indian investments. But when you take into consideration global investment, obviously the returns would be hampered if the rupee is appreciating. But yeah, so Pramod sir is he could better explain the
No,
currency and
there was one question from Cherian. What will
uh-huh.
happen to the performance of the fund if, say, the dollar is devalued at 80 rupees per dollar?
Yeah, so like I said, we look at companies which are compounding cash flows at 15% dollar terms. That is the core return. And let's say we run into bad luck. So, what situation you are painting has never happened before. There was a period between 2003 and 2010. The rupee was stable against the dollar, but it did not appreciate. But let's assume it happens, and it happens over a 5 year period. That knocks off 2-3% returns from this 15%. Instead of 15% rupee return, you might get 12% rupee return, which I think is not bad, because in the situation that your dollar has fallen to 80 rupees to a rupee, your global comes cheaper. Therefore, you can live with less returns. What did I say? What are we planning for? We are planning for the worst scenario.
Hmm.
Insurance is planning for death. So if I don't die, it's a happy thing, no? So
Okay. Jagannath sir is asking, sir, we have US funds in India. Why should we invest into this fund mostly 75% in US? I think he said this fund is not for NRIs. This fund is for Indians who want to invest in the US. I think you might have just confused. Matlab, for a normal person like me, if I want to invest in US, I do not have an option to go and invest. I can't open an account, a broking account. I don't know if some companies offer or it. I still don't know. But to go and buy Apple or to go buy Alphabet or to do the research, which company is good for me, for a layman or for a normal salaried person, I think it's best for me to invest 5 lakhs with Marcellus and let them do the research and do the investments. Whatever profit or loss, it will be mine. So,
unless he was referring to some US funds available through the mutual fund route, as
but
a
there are close.
clarification, like I said, that route is shut today because of the $7 billion limit by RBI. Most of those funds are not taking fresh subscriptions.
Okay. So Ronald is asking the question, since this is not available in Fund Bazaar, okay. How long will this only the physical process go through, or how will it be happening? Like the NFO route, we have done the physical application, or online we have just clicked, you gave some link, we put the application, enter everything, and that last moment of transferring, what the three funds banks which we had tie up, okay, we did the transfer. Otherwise, we had to go physically to the bank and do the transfer. Okay, so that process is going to be continued forever, or how it will be? Will there be any changes in that?
No, so we have the digital process as well as the physical process. The digital is both for onboarding as well as fund transfer through those four banks. The physical you can do with any bank for that matter. We will also work with Prudent's team to integrate with Fund Bazaar. We are working on a mechanism so that it's not just the returns and the global diversification. We are also able to offer you convenience. Convenience is most important. But because Gift City is new, Global is new, LRS is new, a lot of the ecosystem vendors are not familiar. But it'll happen. Like I said, a lot of new licenses are being given out in Gift City, so we should be able to solve it using technology. Hopefully, we'll bring the good news soon to you.
Sir, almost 8 to 10 partners have requested for the onboarding process once. So I'll request KB to present it once to everybody, live demonstration. So I'll take care of that. Yes, sir, we will do that onboarding system. Okay, a lot of one pages and everything we will start circulating from today. Portfolio also we will circulate. Everybody is asking where to fetch the portfolio from. We will circulate it. Say anyway available on Marcellus website, but we will
Correct.
fetch it and down send it for you. So NAV will be updated on a daily basis. The one
Daily basis.
then was always there. Okay, is it fund or a direct investment? Is it fund of fund or direct investment? People are asking, sir.
Direct. So we, like I said, the fund manager is a Marcellus employee only. The whole fund management team Marcellus. In fact, we were one of the few fund houses in India to have direct investing, not through fund of funds. Fund of funds adds a layer of cost to you because the fund in which you invest will also charge TER, so it will become very expensive and a drag on returns. We are one of few Indian asset managers to have a global fund management team in house.
Great, sir. I think that's it. Thank you, Pramod, sir. Thank you for your time. Thank you for the lovely presentation. Thank you, all the partners. Almost 130, 140 were there till the end. Okay, very, very lovely. Very, very thank you, sir. Really appreciate. Okay, I'll conduct this. No, sir, SIP as of no option is not there. You can do monthly 2,000 rupees if you want, monthly $2,000 if you want. Okay, so yes, sir. Thank you, sir. Thank you very much.
Thank you. Thanks, Kapil. Thank you, everyone. Look forward to your support. Do we all want to do the right thing for our mutual clients? We do well for our clients. Our clients do well. Our interests will be looked after. So, look forward to partnering with you in this.
Thank you, sir. Thank you. Good, goodbye, partners. Good night, sir.